Understanding your net worth is essential to obtaining insight into your financial well-being. How am I doing financially, and are my financial goals being met? Are two of the most commonly asked questions. These questions and more can be answered by tracking your net worth. It's one of the most fundamental principles of wealth. Welcome back to our channel, and today it's all about understanding your net worth. On your financial journey, there are a few items that you'll continuously need to keep track of, and your net worth is one of them. This is a broad level indicator letting you know if you're heading in the direction you want for your financial goals. So let's get things started. What is your net worth? Your net worth is an excellent measure of your financial well-being because it shows whether or not your total assets are worth more than your total debt. In financial planning, such as purchasing a home or a business or formulating a retirement strategy, one's net worth can be an essential indicator. The value of your assets minus the amount you owe on your loans or expenses is your net worth. Put another way, your net worth is the amount you have left after paying off all your debts and obligations. A positive net worth indicates that you have more money than you owe, which is a good predictor of your financial well-being. Assets include retirement accounts, home, automobile, jewelry, art, and other items of monetary value. Liabilities includes all of your debts, including mortgage payments, auto loans, credit card debt, and student loans. How to calculate your net worth? It's the difference between the value of your assets and obligations. Simply put, everything you own less everything you owe is summed up in one number that is your net worth. It's a clear picture of where you stand financially. Creating a balance sheet is the best technique to determine your net worth. List all of your possessions in one column, along with an estimate of their market value if you had to sell them. In the second column, write down all your debts. Your net worth is the difference between your assets and liabilities. For many of us, the initial calculation of our net worth can be a negative number, meaning we owe much more than we own. That's okay, because now we know what to focus on and how to better plan our next steps. Step 1. Identify your assets. Calculating your net worth is not as straightforward as it appears, but using this tool to plan your finances is crucial. In our lifetimes, we accumulate a wide range of financial resources. Take a critical look at what you own and where you keep your money to identify all of your assets. What are your assets that can be sold for cash? This list should include everything you possess that has a monetary value. Estimated values are available to you in some instances. Accurate estimates of real estate and automobile worth are available through resources like Kelley Blue Book and Zillow. When calculating net worth, it's best to be conservative when estimating market value where you don't have one. You also have checking, savings, money market, and other bank accounts. To get a clearer picture of your financial situation, you should add your IRA and 401k funds and any other investments such as stocks, bonds, gold, or cryptocurrencies. Also, don't forget to include any business interests or other assets you may have. Step 2. Identify your liabilities. As part of a comprehensive financial plan, you must include all of your outstanding loans. Debt that you must pay back in totals, such as personal and school loans, must be recorded as a liability on your financial statements. You can look at your most recent loan statement to determine how much money you still owe and then use that amount to calculate your net worth. In other cases, the debt is related to a specific asset, such as a car or house. When calculating your net worth, take into account any outstanding loan balances. Your home would be worth less than its assessed value if the outstanding mortgage debt were considered when determining its asset value. Your net worth includes the value of the difference between the two estimates. Credit card debt, money owed to store cards, or any other outstanding obligation should also be included. Don't forget to consider any business debt secured against your personal assets. Debt incurred using personal credit cards or a personal loan to fund your business is not considered business debt. Net worth can be calculated if you're satisfied that all your assets and liabilities have been considered. You might utilize one of the many available internet calculators to make things easier. When calculating net worth, make sure to include everything and be as practical and as honest as possible with yourself. Step 3. Track your net worth. Tracking your net worth may be time-consuming, but it's necessary to truly understand where you are on your financial journey. You can utilize a spreadsheet like Microsoft Excel or Google Sheets to manually input your data. Some people like this method as they can completely control the values and how the information is presented. For those who don't want the manual effort, there are a number of apps like Personal Capital and Mint that can help you track your net worth and do all of the math for you. Because time is money, this saves you both time and effort. Make a system that works for you and keep it up to date. Step 4. Having a goal for your net worth. Financial planning can be tracked on a baseline established by the creation of a balance sheet. Obviously, you want to grow your net worth over time so that when you retire, you'll be worth more and have more money to sustain you. At different points in your life, you should consider setting different net worth goals. Personal Capital estimates that the typical American's net worth is $6,676 at 35 years old, $84,542 at 50 years old, and $194,226 at retirement age. Though these numbers may look large, with the rising cost of health insurance and our cost of living, this is not enough. One of the ways we can increase our net worth is by generating passive income. We must devise a strategy for putting our money to good use. Investing in real estate has historically returned an average of 6.4% per year over 36 years. Therefore, owning real estate typically increases in value and can provide you with passive income. Market investing has historically generated around 7%, depending on the account invested. With compound interest, even a low rate of return can develop into a large sum of money with enough time. Brokerage accounts, CDs, and individual retirement accounts, IRAs, can also provide passive income. These accounts are insured by the Federal Deposit Insurance Corporation, the FDIC, and can be less hazardous than riskier investments. If you want more help on how to increase your net worth, you can always consult with a financial expert. Remember, your net worth will be what carries you through retirement. You must take a hold and plan on how to increase it so that you can sustain the life you want during your retirement years. Well-known business consultant and author Peter Drucker has a memorable quote, "If you can't measure it, you cannot improve it." In other words, it's easier to improve items that can be measured. Checking up on your net worth is a great way to spur growth. It lets you keep track of your spending and bills and make adjustments as necessary. As a bonus, seeing your progress motivates you. As we've discussed, there are several options to track your net worth. Whatever approach you use, the most essential thing is that you stay informed and keep it updated to better understand your direction and how fast you're going there. That brings us to the end of our video. If you learned something new today, like this video and share it with your friends. Let us know what you think in the comments section below, and we'll see you in the next one.